Hello everyone and welcome to our home office related party costs documentation discussion. For an agenda for our discussion today, we are going to be going through an overview of home office versus chain organizations, how to establish a new home office if you do not already have a number, the discussion of home office versus other related parties. We'll talk about the related party costs rule or principles. We'll go through worksheet S-2, both parts 1 and 2, some of the control questions there. We'll cover the worksheet A81 and how it interrelates with worksheet A. We're going to go through a variety of issues related to A81, worksheet A81. Then we'll cover some other home office related party issues. And then finally, we'll end with a discussion of acute care hospitals allocating costs out to a critical access hospital. So a main reason for this presentation today relates back to the federal fiscal year 2019 IPPS final rule, and this was the August 17th, 2018 Federal Register. Now this change, when it came out, it led us to update our website with a variety of information, and this YouTube video is meant to be an expansion of that, bringing together some frequently asked questions and just some issues that have been raised during the actual desk reviews and audits. So this Federal Register, this final rule, made many changes to documentation that's required at cost report acceptance. Now, we've covered a lot of these other changes, including bad debts, DISH Medicaid eligible days, the S10 charity care charges, and the total bad debts. We've covered many of those in other videos and other websites. This video today is meant to be focused just on the home office aspect of this. Now the change here in this final rule, as we'll see in just a bit, was made to help clarify when home office cost statements or other documentation would be needed to be filed. And it helped to clarify what constitutes a home office or a chain organization versus some other related party cost. So we'll talk a little bit about both of those. But as we'll see in the next quote, the rule is that if you have two or more entities, if some organization, some management organization was providing service to two or more entities, whether these are healthcare providers or it could be one provider and some other entity not even related to healthcare, but if the entity, the chain entity, is allocating costs from that related party to the other entities, that's what we're talking about here. Now, obviously, there has to be at least one provider, otherwise this wouldn't even be a discussion, but the other entity does not necessarily have to be a provider. So, in these situations, the home office cost statement must be submitted just one copy to the actual MAC that is servicing that home office. Originally, CMS proposed that all MACs would have to get a copy of that, but they finalized the rule saying that only one copy needs to be sent to the MAC servicing the home office. And then it's that MAC's responsibility to pass it on to the other MACs that need it. So here is a quote, two quotes or two sections of a quote from this final rule. And as I mentioned, the chain organization consists of a group of two or more healthcare facilities which are owned, leased, or controlled. In other words, they're a related party. Later on in that quote, it says that this chain organization may also include business organizations which are engaged in other activities not directly related to healthcare. So that's why you could have other entities we're dealing with. But the main point I wanted to make here is that with some sort of management services being provided to multiple parties, it's important that we have the documentation to show how those costs were allocated out to those multiple parties, as opposed to just a large percentage of it being allocated to a Medicare provider and a much smaller percentage being allocated to some other entity because there was no concern about reimbursement for that other entity. So again, documentation is key here. Now, that final rule obviously identified certain situations where home offices needed to be created and that vehicle needed to be utilized to submit this documentation. So after that final rule was issued, there was certainly an understandable increase in the number of home offices being established so that the providers and the home offices could meet that requirement. This was updated in our website. Here's the link to that website. And there's information there about how to establish a new home office. We go through a lot of the same things we just talked about. Now, the point about a home office, when you have a formal home office, is that there is a form set known as the 28705, CMS Form 28705. That is required to be submitted so that Max can actually audit the cost itself as well as the allocation of that cost to the various entities. Now, again, since this was in that Federal Register, failure to submit the home office cost statement that supports that home office cost that a provider reports on their cost report would result in rejectance of that cost report. Now, one of the things that was brought up in that final rule was due to the fact that a home office may have a different fiscal year end from the provider itself. In that case, one provider's cost report would be pulling data from 2 or possibly more home office cost statement periods. So in that situation, CMS basically said you at least have to have a portion of the cost supported. If that's the situation where the fiscal year ends are not the same, you at least have to submit the cost statement for the first part of the year, essentially. Now, if you do not already have a home office number and you need to have one established, there is a new home office questionnaire that we'll see in the next slide, and you can submit this via email to our audit area if you want to use the audit advisement at WPSIC.com website, or if you want to email it directly to the home office coordinator at this address down here, you can do that as well. And this way you will get a home office number established. You'll be able to actually submit a cost statement, meet that requirement, and of course the data would be audited through a desk review, through an audit, just like a provider cost report would. This is the new home office questionnaire. It's a very brief questionnaire. The first question just identifies or asks you to identify the listing of the healthcare facilities that the home office provides service to, including their Medicare number and MAC, so we know who is all part of this chain. Number 2, what types of services are provided to the chain organization? Number 3, what is the organizational structure? Number 4, what is the effective date of the home office and the fiscal year end? And then number 5, is this home office affiliated with any other home offices? So for example, there might be a situation where you actually have a regional office that supports multiple home offices and of course multiple providers. So you might have the high-level home office and then regional offices underneath of it and then the providers underneath of that. So once that questionnaire is submitted and your number is approved and sent out to you, then you can actually file a home office cost statement and go through the formal process for that. Now, the other question that comes up is basically, is this required all the time? There are any related party costs at all? And as we mentioned up front, if it's a situation where you have multiple providers or multiple entities that are being allocated cost from this central management organization, this chain organization, this home office, whatever term you want to use, then that would be considered a home office. But if you have a situation where there's just one entity providing services to this actual provider, this other entity, and perhaps they're even billing them for that cost, and the provider is actually incurring the cost. So there may still be relationship through ownership or control, so it's still a related party, but that may not rise to the level of a home office. It might be considered an other related party cost. Again, that's when the services are just being provided to this one party. There's a direct relationship identified. There's an incurred cost situation where the provider is getting billed and invoicing and paying the costs, as opposed to overhead costs just being allocated. That's really the point here. If there are overhead costs that are just being allocated to the provider and the provider is never really having to pay for them or incur the cost, that's a situation where you would need to have a home office involved. If there's no incurrence of the cost, then that would be a home office. And that's what I'm trying to get at in the second bullet point, directly incurred costs versus allocated costs. If it's directly incurred by the provider, then we would be requiring documentation for the invoice and the payment of that invoice to support the cost. Now, if it's an allocated type cost through a home office, then what we'd be looking for, first of all, is proof that the home office themselves actually incurred that cost. And that, for example, on the home office, that's going to be your schedule, your trial balance there, proving that they incurred the cost, all the documentation related to that. And then we also need documentation for the proper allocation of those incurred costs to the providers or other entities. So this is where the statistics come into play. We're going to be looking for either direct assignment. There are certain costs where you know they only belong with one particular provider and not any others. There's some sort of evidence showing exactly how much needs to be allocated to that one provider. That's direct assignment. It actually shows up on Schedule E of the home office cost statement. In many other cases where you don't have direct assignment, you have no way of directly identifying it. The costs, for example, payroll, certain IT type services, they may be allocated functionally. Functional allocation basically means there's some sort of statistic that has a strong correlation with the utilization of that service. Now, when you look at a provider cost report, this would be very similar to what we're doing on worksheet B and B-1 with all the various statistics, other than A&G and the accumulated cost. All of the other statistics are functional type statistics. So that's the exact same thing that would show up on the home office cost statement. That's Schedule F of the home office cost statement. As a last resort, if you are truly using a home office cost statement and there is no other way to allocate the cost out functionally, and of course you can't directly assign it, then the last resort here is the use of a pooled statistic. This is Schedule G of the cost statement, home office cost statement, and that would basically be either total patient days as the statistic or total cost as the statistic. Obviously, there's a very weak correlation generally between the number of days one provider has versus the rest of them, or the amount of costs that provider has versus the rest of the providers. There's a weak correlation there between that and how much of particular management service costs they should be allocated. But that's, again, it's a last resort. If there's no better way to do it, then that's allowable on the home office cost statement, and only on the home office cost statement. That type of allocation, that pooled allocation, is not allowed outside of a home office cost statement environment. Now, all of this documentation, all this review that would take place is subject to the underlying related party cost principles. And what this basically says, if you go to CMS Pub 15-1, Section 1000, says the costs applicable to all these different services, etc., furnished to the provider by related organizations are allowable to the provider at the cost to the related organization. In other words, even if the home office charged $50,000 for a particular batch of services and the provider paid $50,000 back to that home office or whatever other related party it is, that $50,000 itself is not necessarily allowable. We would be looking for what the underlying cost to that related party truly was. In other words, what was the underlying cost to the home office in providing that service to the provider? Any sort of profit or inflation on top of that will not be allowed. It's only the underlying cost. So this policy says it all. Now, because of the various requirements that come into play with home offices, there's an importance for transparency. The auditors need to be aware that these costs exist within this provider cost report, this hospital cost report. So the next section we're talking about are a few different control questions on worksheet S-2, both part 1 and part 2. So worksheet S-2 part 1 has a question on line 140 that specifically asks, are there any related organization or home office costs as defined in the policy manual chapter 10? Enter yes or no, and if it's actually a home office versus just some other related party, you would also enter the home office chain number. So here, this fake home office number HB9999, we said yes, there's a related organization, and hey, here's the provider, here's the home office number. Now you might have a situation where, hey, we have other related party costs, but they're not home offices. In that situation, you'd put yes here, and you'd leave the second column blank. Now down here, we're looking for information about that home office number. Now on worksheet S-2 part 2, we have a couple of questions. Line 3, specifically again, now part 2 is the hospital reimbursement questionnaire. Some of you may recall this used to be a CMS form 339, and in 2010 that was merged into the hospital cost report instead. But in any case, line 3 asks again whether there are any related party transactions, and it goes into a little bit of detail about that. Are they involved in any business transactions, etc., with parties that are related to the provider? Line 36 specifically asks whether or not there are home office costs claimed on the cost report, and was a home office cost statement prepared by the home office? Was the fiscal year end of the home office different from the provider? If so, detail that. If line 36 is yes, did the provider render services to other chain components? And did the provider render services back to the home office? So keep in mind here we're talking about, initially we're talking about home offices allocating costs down to the provider, but now we're saying the provider themselves might be providing services back to other chain components or even to the home office itself. So next we're going to talk about the purpose of worksheet A81. Now there are a variety of A8 type worksheets. We have A81, which is the main focus here relating to related party costs. We have A82 and A83 for other issues. But all of these A8 series work papers are related to adjustments to amounts that were initially reported on worksheet A, which is the trial balance. Ultimately, all of these adjustments flow back to worksheet A to determine the allowable cost after reclass, after adjustment. Again, A81 is specifically related to related party costs, and generally speaking, this has been a downward adjustment. So on worksheet A, as we'll see in example 1, you might have costs that have already been incurred by the provider. So for example here, the provider reported $15,000 on a particular cost center of worksheet A for particular related party cost services, but the underlying cost of those services was only $10,000. So worksheet A81 would be used to adjust out that excess $5,000 to bring the $15,000 down to $10,000. Now the other thing I want to point out here is that on this particular cost center, there are very likely other costs and other services that have nothing to do with this related party. So we need to focus in on just this portion of the amount on the cost center and find out what service it relates to and ultimately what the underlying cost is. It's only 10,000, so we're going to adjust out 5,000. So again, normally this is a downward adjustment. That was the original intent of this worksheet, to adjust out that excess profit, excess markup. However, there are situations in example 2 where provider did not report any costs at all on worksheet A for that particular related party transaction in the particular cost center. Now, the reason they may not have reported any costs initially is most likely that they did not incur the cost directly. They were not billed for that service. They did not pay for that service. The costs were just allocated to them from a related party, from a home office specifically. So in this situation, there is currently 0 on worksheet A related to this transaction. However, let's assume that $10,000 is the true underlying cost. We can support that. We have a home office cost statement documenting that, whatever. So $10,000 has been allocated to the provider, and it's documented on A81. In that situation, we have to have an A81 adjustment to bring in an extra $10,000 to bring the 0 that's on worksheet A up to $10,000. Now, it's important to understand how that works on worksheet A81 because it's not all that intuitive at first glance. We have a few different columns on worksheet A81. We have the column 1 reflecting the line number or the cost center number on worksheet A that we're dealing with. So for example, we have 6 different adjustments that we're documenting. One of these adjustments impacts line 1 of worksheet A, which is capital related costs, buildings and fixture. One of the adjustments affects line 2. 2 of them affect line 5, which is A and G. And that's perfectly fine. That just really highlights the point that on worksheet A, for each of these individual cost centers, there may be several different types of transactions, possibly from multiple related parties. So we'll talk about that in just a bit, but that's the point here. This cost center 5 has these 2 different transactions. Some home office other costs, and in fact, this second instance, miscellaneous related party and home office, this in and of itself might reflect multiple transactions as well. And I'll get to that point in just a bit. So we have, the transactions are broken out, but then we get to the heart of this worksheet, column 4 and column 5. Column 5 is the amount that has already been included on worksheet A for this particular transaction. In other words, the provider has already incurred this amount of cost, and it needs to be adjusted either down or up for one reason or another. So this is the amount that's already there. Column 4 is how much of that amount is allowable. Now again, we went through a couple of different examples earlier, and example 1 would be closest to this one right here, this 4th entry, where for this transaction or for these transactions, $203,785 has already been recorded on worksheet A, column 5, but only $200,456 is allowable. So it's being adjusted down. But as I said earlier, there might be situations where the adjustment is up. So in this case, for these first 3 lines, nothing was reported on worksheet A, column 5. However, we have documentation to show that some amount is allowable. So in that case, column 6 is just what will the adjustment be? In other words, the difference between 4 and 5. So column 6 will show large positive adjustments to add this amount in. This 4th line is a small negative, and the 5th and 6th lines, it's a relatively small positive. So they incurred some of the cost, but then for whatever reason, there's more that's allowable. Maybe they didn't incur all of these lab costs, and the amount is actually higher, the allowable amount after allocation. To reiterate my point here about what is on column 5 here, column 5 of A81 reflects column 5 of worksheet A, but again, let's take this line 5, this fourth line down. This $203,785, you do not expect necessarily to tie that to anything on worksheet A, because more likely than not, this is just a small portion of the amounts reported on worksheet A, line 5. There's probably a lot of other non-related party costs that are there. So line 5, let's see what line 5 actually has. Now remember, we're looking at line 5, column 5, which is after reclasses but before adjustments. That's nearly $10 million of cost that's reported there. So this $203,000 is a very small portion of that. And that's fine. We're saying this is one transaction potentially out of several different types of transactions. And then you'll notice all of the adjustments, including the related party cost and a variety of other adjustments, they're brought in on column 6. Now, the problem with the current design of worksheet A81 is that there's nothing indicating which of these transactions, which of these amounts relates to a particular related party. There might be multiple related parties a particular provider is dealing with, and there's nothing telling us that, hey, this 1.4 million is related to only the home office or only some other related party. Yes, there is column 3 that you can use as a brief narrative. And if you look at the first 3 lines, it specifically says home office, home office, home office. So assuming this provider just had one home office, and also assuming their home office matched this same fiscal year, then yes, it makes sense. We would be able to find these amounts on the home office cost statement pretty clearly. But let's say there were multiple home offices, maybe a home office and a regional office, or let's also say that maybe the home office had a different fiscal year end than the provider. It's going to be quite difficult to track this $1.4 million down on one or the other home office cost statement. So that's one of the problems with this. As it's designed, you could have several different things that are impacting cost center 1 merged into one line here. Even though, let's say there might be 2 home offices involved, 2 different years, for example, maybe a few different other related party transactions. All of that stuff could be rolled into one line. But when we are doing the audit, we're going to have to ask providers to document that split. Break down this 1.4 million into its various components, because then each of those components, each of those pieces of that cost, we will need to see what related party cost documentation exists to support it. So that's one of the problems. And as I said here, lines 1 through 3 on the A81, they appear to be just one home office. So assuming they have the same fiscal year end, this would be pretty straightforward. Line 3.01, this one is probably even more troublesome. It says miscellaneous related party and home office. So based on this description, this $200,000 really comes from 2 sources. But we have no way of knowing, just by looking at this, how much comes from home office documentation, how much comes from some other invoice from another related party. Line 3.01 and 4, they're just not clear at all. We don't know where the lab cost or the cardiology cost comes from. It could potentially come from multiple parties or whatever. Now, we have actually proposed to CMS to clean this worksheet up a bit and require that each cost listed here can only relate to one related party. So if indeed, let's say this line 5, if indeed this miscellaneous related party and home office cost, this $200,000, let's say $100,000 came from related party 1, $50,000 came from related party 2, and the other $50,000 plus came from related party 3. If CMS makes the change, and certainly we recommend this even under this current design, that should be split into 3 separate lines of worksheet A81 and clearly identified which party it comes from and how much comes from that party. That will allow us to better review the documentation without having to ask you as a provider many, many more questions and see a lot more documentation. If it's clear and transparent up front, this will limit the number of questions the auditors have to ask you as a provider. So again, no matter what, documentation is needed to support column 4, and we're likely also going to be needing to see a detailed trial balance to show us, to prove to us that yes, indeed, $203,000 was indeed already recorded on worksheet A, and it related to this particular transaction. Because to get a proper adjustment, both column 4 and 5 need to be accurate. Now, the next page of this slide, we're going to move on to just a variety of other issues related to home offices and other related parties. So the key thing here is that no matter what type of related party costs we're talking about, it has to relate to specific services. A home office is just not able to allocate overhead cost just because. They have to show that this cost related to services provided to the provider. So again, the home office cost statement, a large purpose for that is to show this allocation, but as we are auditing the home office and or the provider, we'll be looking for source documentation showing what the service was, what the cost was, and of course it's subject to its own reasonable cost review. Now, when we get to a home office, when we're talking about a home office specifically, they can have direct assignment, as I mentioned earlier, that's Schedule E, functional allocation using statistics on Schedule F, or pooled allocation as a last resort using statistics like total days or total costs. Those are on the home office cost statement. So the key thing I want to point out here is that the pooled allocation can exist on a home office, but if it's a large percentage of your overall allocation, this is going to be a red flag, and the auditor may be asking questions about that. They may be digging down, asking if you really had no way of functionally allocating that cost. Was there no statistic that existed that would be a good driver for that cost, a good way of measuring that cost? Now, when we talk about other related party costs that are not on a home office, these must either be directly assigned, which is certainly preferable, or at a minimum, they have to have a functional statistic showing some sort of correlation between the usage of that particular service that is being costed from provider 1 to provider 2 or whatever. So it has to be a functional allocation with a strong correlation for that statistic. Pooled allocation using total days or total costs will not be allowable if there's not a home office cost statement involved. So if it's just an other related party cost where there's just some sort of invoice being sent, then some sort of allocation of total cost, total allocation using total cost or total days, a pooled allocation, so to speak, that will not be allowable for the documentation there. Regardless of the fact that the provider incurred the cost and paid for it, keep in mind, just because they were charged an amount doesn't mean that charged amount is going to be allowable. We need to see the underlying cost to the related party that provided the services in the first place. Finally, we have a discussion that has come up over the past few years. There were a few court cases and appeals on this, and this relates to acute care hospitals that allocate costs to critical access hospitals. Now, the big concern here from a CMS, from a program perspective, is that acute care hospitals are not reimbursed generally based on cost. Yes, there are some cost-based reimbursement methodologies in an acute care hospital, some pass-through costs, but as a whole, they're not reimbursed on current year cost. Critical access hospitals, on the other hand, are directly based on cost. In fact, it's usually 101% of that cost. So as you can see, there's certainly an incentive and a concern, if you will, where an acute care hospital may be shifting costs to the critical access hospital because of the fact that there's going to be more reimbursement there. From a program perspective and an auditor perspective, our job is to ensure that any sort of allocation is proper and that excess cost shifting is not taking place. So this goes down to the same rule that we talked about a bit ago. There has to be clear documentation regarding what services are being provided from one party to the other, and truly what is the underlying cost. Not just what is charged, but what is the underlying cost. Now, a common way for this cost to be established, in other words, how much of the acute care hospital's total cost really related to services being provided to that critical access hospital versus some other department of the hospital itself. So the CAW can be set up as a non-reimbursable cost center on the acute care hospital cost report for the purposes of allocating costs down to it. Now, this would be done on worksheet B and B-1 using the same statistics that any other true department of the hospital would be using. So this essentially represents functional allocation, like you might find on a home office cost statement, but here we're using the acute care hospital in lieu of a home office cost statement. So this situation can exist, and it again represents functional allocation, but the key thing that we have found with this, the key thing CMS has brought up with this, is that on basically columns 1 and 2 of worksheet A, where this CAW non-reimbursable cost center is being established, you cannot start with some sort of cost that's being moved over from the CAW cost report. What we've seen in some cases is that a CAW, all or most of its cost from the CAW cost report itself, is brought over to start that non-reimbursable cost center. And the effect this has is that since you have such a large amount of cost coming over for this quote-unquote department, this non-reimbursable department, so to speak, that is going to pull a lot of allocated cost from the accumulated cost statistic and the administrative and general cost center. That's the effect it has, and that's an improper effect. The critical access hospital, yes, it can be set up as a non-reimbursable cost center, but it has to start with zero cost unless some specific cost can be directly identified as being related to this service. And then this would be done through a reclass from the whatever other cost center the cost existed in down to this non-reimbursable cost center. That would be a direct assignment, essentially, and it would be assigning it out of the acute into the critical access hospital non-reimbursable cost center, which of course would eventually be moved over to worksheet A81 of the critical access hospital cost center or cost report. But the point is, that's the only way that you would have anything on column 1 or 2 of that line of worksheet A on the acute care hospital's cost report. If there were no direct assignments that would allow them to pull down more of the A&G cost, then the only thing left would be functional allocation. And again, I said how this impacts your A&G step down. Assuming there were no direct assignments to start that cost center off, then the only way this critical access hospital non-reimbursable cost center would have any A&G step down to it at all would be based on how much capital or employee benefits were stepped down first to that critical access hospital. Because A&G, the A&G cost center, is immediately after these cost centers. So if no cost has been developed from these first two cost centers, there's going to be nothing to pull down A&G. So that's an important point. Anytime we see a non-reimbursable cost center being used in this fashion, and we see some amount on columns 1 or 2, that is a big red flag. We're going to be looking for documentation on how you directly identified that cost. And if we find that it's just a large portion just pulled over from the critical access hospital, that will immediately be adjusted out. That's not proper at all. So that takes us to the end of this discussion on home office costs and the different allocation techniques, the worksheet A81. I hope this has helped to clarify some of these topics. Of course, we have the various other pieces of information on the website. But I thank you for your time, and have a great day.